I'd like to introduce FFCON20's Platinum Partner and Keynote Speaker. He's a tech entrepreneur, an innovator, an investor who deeply cares about making the world a better place. I'd like to introduce James Wallace, the co-chair and CEO of Exponential, to kick off today's Sustainable Finance Program with a talk on how digital securities will end financial exclusion. Standing by live, over to you, JW.
Thanks, Greg. Very happy to be here. I took a look at the itinerary and it's full of just legends. Looking forward to taking it all in for the rest of the day. I'm going to jump right in because I have hours of content here and I'm told I have 20 minutes. So I'm going to dive right in, and I'm going to start with a very controversial thought, which is right now what you want doesn't matter. And said, I think more specifically, more than 90% of the people have zero effect on government. And you may be thinking, what does that have to do with fintech and funding and financing? I'm going to get to that in a second. But I want to explain that a little bit more, because obviously that's a very controversial comment, deserves some evidence. So a 20-year-long Princeton study resulted in this single comment. The preferences of the average citizen appear to have only a minuscule, near zero, statistically non-significant impact upon public policy. That is a profound statement from a very serious institution. Now, after 20 years of data and research, they came up with a graph that is not showing on the screen, which is fine. I will describe the graph and ask you to use your imaginations. Let me see if I can, oh, there we go. It's even cooler than I recalled. We have it programmed, ladies and gentlemen. So on the left-hand side, you see likelihood from 0% to 100%. What that likelihood means is the likelihood of something becoming public policy. So I will kind of jump to the end and say, maybe replace public policy with monetary policy if your sole or primary interest here is financing or fintech. But I think that realizing government's role in creating monetary policy is very important. Anyway, back to the graph. At the bottom, we have support, and on a scale from 0 to 100%. Ideal representation in a republic, in a democracy, would be that perfect line, that diagonal line that goes from 0 to 100%. In other words, if there's 50% public support, there'd be a 50% likelihood of it becoming public policy. 0% support, 0% likelihood, 100% support, 100% likelihood. Now, the bottom 90% of constituents, the bottom 90% as it relates to the impact on government, specifically the amount of money that they have, the amount of money that they contribute to government, has a 30% likelihood of impacting public policy no matter what. So as you can see, instead of a diagonal line, it's actually a vertical line at 30%. So at 50% support, a 30% likelihood doesn't sound too bad. But if we jump to either end of the spectrum, something has 0% support, meaning every single citizen in the entire nation does not support this public policy. It has a 30% chance of becoming public policy. On the other end, which may be a little bit worse, if something had 100% support from the public, it also has a 30% chance of becoming public policy. Now, the longer you sit with that, the harder it is to accept it, to stomach it. And the more the implications kind of flood through. And it's very confusing. We need to look at one more line, and that is the elite representation. And elite, again, is the top 1% of wealth holders. They are the people that typically influence government through lobbyists. And that's essentially the question. How is this possible? I mean, well, ultimately, the enemy is exclusion, but how is that exclusion possible? How can a select few people impact public policy and monetary policy? And the answer is hard and soft corruption. Hard corruption is that classic Hollywood style, pack an envelope full of cash, slide it across the desk, and you get that result that you want. The soft corruption is lobbying. And in the West, the quote-unquote developed countries, we prefer soft corruption. But we've ended up in a situation essentially where the wants and needs of the democracy or the republic are not being met by the policymakers. And so, again, the core issue here that we see is exclusion. So to move back to something that is slightly more relevant to this event, this webcast, although, as I said, I think it's really important to look at the public policy influence is directly related to monetary policy. The issue that we have here is that we have worldwide more than 99% of people are excluded from most of the financial system. Specifically, let's look at two things. One is banking and one is investing. On the investment side of things, we have in North America and in the US and Canada accredited investor status. Worldwide, it's known as professional, sophisticated, etc. And this essentially is, and regulators say that accredited status is required to ensure that the person understands the financial investment or the product well enough to be informed. But the reality is, and what we've seen time and time again, is that there's a significant number of accredited investors that don't have any financial intelligence. So third generation rich that has not built a business and doesn't understand financial fundamentals, that has a significant bank balance can invest. But someone like a young investment banker that literally has a post-secondary degree and has spent their entire careers working on investments and understanding securities is prohibited from making that investment, which just simply doesn't make sense. So looking at, obviously there needs to be reform there. You know, what a regulator might see as high risk, I see as high reward. So removing the exclusion component there is critical moving forward, which digital assets and specifically digital securities, which I'll get into in a minute, will allow not only access to that in a responsible and suitable way, but will allow regulators to ensure that the spirit of their mandate, and no one is suggesting that the spirit of the mandate not be kept. I think investor protection is critical and paramount, that the spirit of that is actually held, but more even distribution, more even access to financial investments and opportunities is available. On the banking side, just a quick note, access to banking, like storage networks and payment networks, is absolutely critical for robust economies and financial fitness and financial fairness, and obviously financial inclusion. And a couple shocking stats, 67% of Indonesia's 267 million people don't have access to a bank account. I was recently in Guatemala and I was told that 50% of the citizens there do not have access to a simple bank account. Obviously, getting people access to storage and trading is essential to ensure financial inclusion. I want to shift really quickly to bringing into sharp focus the proposition here and the potential for the entire planet to adopt a system that will allow us to have all the things, to have regulatory compliance, to have suitability, to have fairness, fair access, to ensure the proper handling of securities and trading, to ensure the democratization of access to early stage fundraising and the democratized access to investments. We can have all those things. And I think that Robert Griefeld, who I think is beyond question in terms of his reputation, his experience as former chairman and CEO of NASDAQ, has said that 100% of the stocks and bonds trading on Wall Street today could be tokenized. And in 5 years, 100% of the stocks and bonds on Wall Street will be tokenized. And if we can move forward really quickly into why that's important, I think that the tokenization, which is also known as security tokens, which is also known as digital securities, and digital securities is my preferred term, in part because there is some negativity attached to those terms, for no reason other than a few innovators misused that technology, which happens, but it's been widely reported and it's been sensationalized, and so I think digital security is more reflective of the reality. And really quickly, to differentiate between paper and electronic and digital. And I think people can understand the paper to electronic was simply taking warehouses full of paper, literally paper securities that had to be run across the city. That's why markets were centralized in New York and Toronto and London. We removed that necessity to find those things stored in these big buildings and carry them across the city and instead put them on microchips. That makes sense. The problem with that is that these securities were attached to private databases. And one of the promises of blockchain and distributed ledger technology is the promise that no single source can actually control and therefore potentially manipulate or even lose the data. And so a digital security, what makes it profoundly different than electronic security is that it cannot be, in many, many ways, but very specifically to this chart here, it cannot be lost or stolen. So why are digital assets better? In this case, digital securities better than the regular, kind of conventional paper, offline, electronic security? liquidity, earlier access to buy and sell. The ability for an issuer to create a digital share issuance and then provide that to an exchange is becoming increasingly easier. We've seen digital share issuance go from a couple $100,000 to a few $1,000s, and I'd expect over the next couple of years, as technologies go, it slowly goes to zero. And I think that the revenue model will be based on transactions rather than upfront fees, including issuance and listing, which I'll talk about a little bit later. Speed, transact at will. People think that there's a lot of efficiency in public markets, and certainly much more efficiency than private markets. But the reality is that things actually take 2 to 3 days to settle in typical transactions that are in public markets. Some markets require weeks to settle things. There's a lot of counterparty risk. There's a lot of cost of capital in ensuring that these transactions occur. And there's actually a significant number of failures that increases risk. That all goes away when the settlement happens instantly. That's why you hear this T0, transaction zero, happens in 0 seconds rather than T plus 2, T plus 3, which is 2 or 3 days. Accessibility, this is an important point. Fractionalization is built in, the functionality is there. It's not an add-on, it's not an enhancement, it's not sophisticated. It's just simply a part of blockchain and distributed ledger technology. If we look at Berkshire Hathaway shares, $287,000 last time I checked. A huge, with all due respect to them, because they're known as to be fairly good investors. What a way to exclude people. I mean, you have to. That's a decent sized house in most cities just to get one single share. Well, with distributed ledger technology, we could create an ADR or a GDR, which is a global depository receipt, and fractionalize that to 18 decimal points. And if Berkshire Hathaway shares become worth $1 trillion, we can still buy pennies worth of it. So we determine access points. Global, this sort of technology just really allows for cross-jurisdictional trading. There's never been a good reason for a Japanese issuer to not sell his early stage investments to a German investor other than regulatory complexity and technology ensuring that there was a compliant transaction. Programming Japanese issuance and German investor regulations into a blockchain allows for those to match when they match and allow for a buy-sell scenario when that happens. Compliant, proactive enforcement. Again, regulators are not required now to force issuers, private and public, to send in onerous amounts of details on their company. Instead, they're able to take a proactive stance and actually get a view into the existing trading, which makes the entire thing much more efficient. Transparency, and back to what I said, immutable record and definitive ownership obviously are huge components to this enhanced trading environment. Just a really quick look at why it's better, and for some of you this can be very old news and old ideas, and for a few of you it's not, so it's worth repeating. But most people are very familiar with banknotes and gold, and with currency, I think a lot of people know the characteristics, the attributes that, the difference between the USD and the Zimbabwe dollar and the euro and the Argentine peso is these characteristics on the left. I'm going to skip forward here. Seems that slide is missing. I apologize. Democratizing issuing, listing, and trading is what is happening right now. And so we have security token issuance platforms that really failed to deliver over the last 2 or 3 years. And I think most of these people were well-intentioned and were early and overpromised and underdelivered. And that's often part of the step toward a system that actually works and that provides the necessary functions and features that sort of slide into the background as more and more people adopt it. These digital security token issuance platforms are enabling the listings to occur on these digital securities exchanges. And again, digital securities exchanges really are just federally registered and regulated exchanges that are able to list and trade digital securities. So securities that are on a blockchain somewhere. Most of these, contrary to or in comparison to crypto exchanges, which are unregulated exchanges. Some of them are, I think, legitimate and actually sound from a business standpoint, and also the transparency standpoint. Many, perhaps most, are not operating within regulation, and I think increase investor risk. These digital securities exchanges are operated by people that have been trained. They have post-secondary degrees, they have licenses, and there's strict regulatory compliance requirements. And listing on them is just the same as listing on the Toronto Stock Exchange or NASDAQ. The requirements are just the same, but they are able to understand the underlying technology that allows for massive marketplace efficiency, which I'll be showing here in a second. Just a quick comment again, to really understand the amount of potential here. The digital economy is a multi-trillion-dollar opportunity. And I think people don't actually realize until they take a close look, what is the value of everything, at least in a capitalistic, monetary, sort of commercial standpoint. The trade is many, 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 many quadrillions, but the actual underlying value, the unit economics or the unit value of things, is in the hundreds of trillions of dollars. And, obviously the biggest single asset class is real estate, and that's in, about 275 to 300 trillion dollars. If we look at digital assets, which, in the security space is probably only a few billion dollars, maybe not even, and then the digital currency space is a couple hundred to maybe a few $100 billion. There's an absolutely massive opportunity to digitize all the assets. And for the reasons that I mentioned in a couple slides before, all of those attributes are unlocked. The divisibility, the accessibility, the liquidity, and that will actually allow for more market participants. It will grow the market, and the assets within the market will become more and more valuable. Everyone wins. Inclusion benefits everyone incredibly. One last little slide here, just to drive home the opportunity of efficiency. And some people that are service providers that are providing services that will be redundant and will be obsolete in the near future are not going to like this slide. But for the rest of us that are seeking to innovate, seeking to include, seeking to grow, and seeking to be rewarded for that inclusion and that efficiency and that innovation, I think this is a great slide. About $700 billion a year is charged in service fees just to enable the classical, conventional capital markets and financial system. And when we add more efficiencies and more issuers and more trade, I think we can see that probably going up in the conventional world to maybe near $1 trillion. At the same time, the new technologies that are coming into place that are replacing classical or forcing, I think, service providers to reduce the costs or maybe amalgamate and provide multiple services and features inside of a single entity. These costs are going to 1/5 to 1/10 today, which is, I think, a comment that's really important to make, is that we're not just talking about an extraordinary possibility, a future that is inclusive, where everyone can be, not just have access, but have equity, and everyone can vote for the future that they want, but that even the institutions that are somewhat objective, let's say that's probably the fairest comment on that, are able to justify engaging this new system because it's 1/5 to 1/10 the cost. And that is a very compelling offer. And so we're seeing top-down and bottom-up adoption where institutional investors are getting involved because it's just cheaper and more secure. So less risk, less liability, less cost of capital, et cetera. And the bottom-up, I think, is again like a Kickstarter sort of mindset where people just want to be involved in investments that matter, which I think is the next slide, if I recall. Well, so the new future is the open global asset marketplace, and how incredible that is. I would love to be aware and be plugged into a system that helped me understand, a Senegalese tech startup that was innovating around water purification, and see that and watch them go from idea to idea market fit to product market fit to scale up, and be able to fund them and be able to in some small way. And that's the idea, is that it shouldn't just be for people that can write a $250,000 check and up. It should be for people that have $5 a month to spare and can contribute to something that actually matters. People more and more often don't want things that are Fortune 500-esque. They want things that matter. And I think that this system actually provides that, which is this beautiful last little sunny picture. And I do think that that is actually possible. And everything that we do is toward that idea of meaning and of contribution and of creating that sort of, I guess, retro gilded era where everyone can have equal access. I think that the goal, as I said, is to perfectly democratize access to fundraising and investments. I think that the next step is continuing to encourage the governments that have already shown that they are willing and able to create fintech sandboxes, to invest in early stage startups that have a social impact, triple bottom line ESG mandate, and there are many. We've are in direct conversation with over 30 of them and have verified that these are legitimate, that this is actually something that matters to them. For whatever reason, it seems like the perfect timing of market opportunities and also social sort of unrest that will lead to social innovation, that will lead to a new possibility. So my thought is, and always has been and always will be, that you can matter. And so I started the little keynote here with the comment that you didn't matter, and that is a sad reality. And I think it's really important to reconcile to that reality. But you can matter, and I believe you will matter. And we are going to do everything we can to help everyone matter. I think it really starts with that idea of every dollar is a vote. And so while and until the government excludes you from contributing your thoughts and ideas to public policy, everyone can fall back on that idea that this dollar that I have, that I can apply it to something. And when you apply a dollar to something, you actually encourage that thing to exist. You encourage more of it. It's a vote for more of that thing. And I think that people, as I mentioned, want to be involved in meaningful things. So every dollar that you invest in these early stage startups, every dollar that you invest in this digital asset paradigm that you see emerge around you, and I know it feels really ethereal and you don't know where to touch it, and it's going to become more and more real, is really a vote for a migration from the old siloed, corrupted capital markets to this new, open, democratized, and transparent capital markets, which I think will create the world around us that we most desperately want and need. And so that is all. I'm available, I think, for a little while in Q&A, and I'm looking forward to getting some great questions over there. Thanks.